Up next in today's Beyond the Index conference is WisdomTree. Presenting today will be Global Chief Investment Officer Jeremy Schwartz. Before we begin, I'd like to share an important notice. The following presentation is for informational purposes only and does not constitute an offer to sell or solicitation to purchase any security. Investors should carefully consider an ETF's investment objectives, risks, charges, and expenses before investing. This and other important information is contained in the fund's prospectus, which should be read carefully before investing. The views and information presented are those of the presenter and ETF sponsor. Jeremy, please go ahead.
Well, thanks for having me. Pleasure to be here. I'm going to share some, I have a daily update that I do on our website, this market dashboard. If you like what we're talking about here, we make it available every day with some updated numbers. I won't go through everything because it's quite a long deck, but I'll start with a brief high-level macro comment, then we'll go into the themes and areas of the market we find most interesting today. And on a day when the Treasury is announcing some bond buybacks that are supporting the fixed income market, I thought I'd start with we often talk about the Fed and the macro, but one of the charts that is relevant to things we'll talk about later on the equity premium is just where are bond yields and how have they come? Where are they today? I often talk about the nominal yields versus the real yields. So the 10-year TIPS yield is the inflation adjusted bond yield. When we compare equities and say, well, how much more, compensation to equities are for you versus bonds, we look at the TIPS yield very closely. So, right around 4.6, 2.4 are where these levels are. I mean, we go back 5 years ago, these TIPS yields were negative. You were giving the government $100 and taking, 90 cents on the dollar after inflation 10 years later. So that's kind of a crazy time in bond land. We're getting to be more normal levels. I wouldn't say these are very high returns, but they're getting to be more normal levels. And when you look at, the job that Warsh is trying to do, we'll see how much information we get at the Jackson Hole conference next week. But what you get between the Fed funds rate and the 10-year is starting to be a much more normal level. So you get a 1% premium between the 10-year and the Fed funds. If you go back the last 60 years, that was kind of a normal level. I mean, there was a time, again, just a few years ago, the Fed fund was inverted. We had a higher short-term rate than the long-term rate. That was also not a healthy environment. We wanted the Fed to be cutting rates more quickly back then. Today, you'd say it's kind of a healthy spread. Now the question is where is he going to go? How's he going to react to all the sort of supply situations, the oil price? What is the inflation trend? We've done a bunch of work that says some of the inflation is being impacted by the rental markets. We think that is a little bit cooler than the official data. But they've got a key challenge to talk about how are they going to move policy, what's guiding their decisions, and where are they going. But we think some of the data would support them staying where they are. They just need to communicate better. I think Washington needs to communicate better on what are really is the Fed looking at. So there's a lot more to come on the Fed. The key thing for the economy side, clearly you've got this battle between the conflict in the Middle East, oil prices, and AI. And so I'm going to talk a lot about where we see AI and the markets. But also for the Fed, where's the job numbers coming out? When we look on the right, the initial jobless claims you get every Thursday, that's been a very healthy range. You see no real broad-based job losses happening from this AI story. Now, the new normal job growth might be very low because of immigration, because of the demographics of our population. Powell had talked about 0 to 50,000 as being the new normal job growth. You saw sort of the 3-month moving average spike a little bit higher. You see it trend down after last month. But this is going to be one of those questions of where do jobs go? Is AI going to take some of the jobs? And you hear some of the companies announcing layoffs, trying to use AI as their explanation for why they're laying people off. And we often think that it's more about they had overhired, overextended, they had a lot of fat to cut, and they're using AI as the explanation. But I think this 0 to 50,000 is the new normal. And again, you don't see any real pickup on the high frequency indicators that we'll get again another number tomorrow. There is this fear out there that, will you have an apocalypse in people losing their jobs? And our senior economist Jeremy Siegel put out this piece. AI is not an apocalypse. We were responding to one of the Citrini research pieces where he put out this scenario about how there could be this doom loop of, people starting to use the AI, starting to cut back workers, and what would that mean for really employment, and then a negative spiral on less people being employed, less consumption, and leading to a real challenging scenario. But our view is that you're going to get higher real wages. If let's say you get enough productivity, you don't have to work 5-day work weeks. You might be able to work 4-day work weeks or 3-day work weeks because you are so much more productive. Well, a lot of people might say they want to keep working higher, and that could lead to more real wage growth. So our big picture macro view, don't be afraid of the jobs apocalypse that some people have talked about. We think it's going to lead to better real wage growth. And it's just like the history of innovation. If you go back to the 1800s, 3/4 of our workers were in farming. Today, less than 2% are farmers, yet we still export food. This is just the history of civilization that we come up with new technologies, new innovations that allow you to do a lot more. And it's scary at the time saying, hey, we're going to be displaced. What are we going to do? But over time we find new jobs and new places to stay occupied. We think this is going to be really no different. Now, also, it's interesting as a firm. WisdomTree made some investments in farmland. This is a chart showing that job growth has gone down from 75% of the economy to 2%. This still could be a very good investment, even if jobs aren't growing or you don't have more people going into that industry. You get very good returns off of farmland today, actually. You get a nice income rate, you get actually inflation protection, you get productivity growth from new technologies that allow the farmers to do more. Now you get some other uses of the land. So just you don't need really an expanding economic footprint to actually have very good returns. And so that's one of the things we had acquired a business called Ceres Partners last year that is helping people get access to farmland. But it's sort of an interesting comment on growth versus return that we often talk about, that you don't need expanding economic growth to have good returns. Now, I think the dynamic that scares people is just how fast innovation is accelerating. And I like this story. I picked it up from social media, but you talk about the progress in automobiles and how long it took for, let's say, if you go back to the early 1900s, we had 25 million horses in the US and they were displaced by the automobile. How long did it take for the horses to get displaced? Well, the first steam engines were in the 1760s. It really took 150, 200 years of progress before the automobile got to a place where you had 25 million horses, then 90% plus no longer had a job. It was a long, long cycle of innovation before the horses were put out of business there. Then you take the more recent examples, the AI versus the machine versus humans. Chess is one of those places where you first saw the potential of the machines, and you first started seeing computerized chess 1980s, and they kept getting steady, steady progress. And at first, the best chess players, grandmasters, would beat the machine 90% of the time, but year after year, the machines got better, and now the machine would win basically most of the time. And so it took about 40 years in chess for the machine to get better than the human. And now, when you look at where the technology is going, you're seeing really, really fast pace of progress and innovation. So this is one of the excitements, but also creating that fear. Is our employees going to be like the horse? And we say, hey, you're not going to be replaced by somebody who knows how to drive. You'll be replaced by a horse who knows how to drive. No, it's you need to be at your cutting edge. If you're an employee using the tools, I encourage all my people to be using all the tools available to them. And really, in some ways, it's a great equalizer for some of the younger people who can get caught up with people with a lot of more experience. And so it's just sort of interesting how fast this pace is happening. Now, there's these questions of, is there overspending? Is the demand real? Can these hyperscalers keep up the spend? Will Anthropic and OpenAI keep spending on the chips? This was some survey data of the companies using AI. We do believe it's a real lasting trend, and we do think it's going to continue, that there's just much more demand than supply for all elements of the ecosystem. But we'd say we're in the, we do a podcast every week called Behind the Markets. In the last few weeks, we talked about where are we in the innings of companies getting margin improvement beyond, say, the true chip companies and like a NVIDIA and the whole ecosystem powering the AI. And we'd say in a baseball analogy, you haven't even started seeing the national anthem for companies that are actually seeing true, as an economy as a whole, real margin improvement. These surveys are saying S&P 500 companies are saying, some are using 40% for revenue generation, a little bit less than 40% for cost reduction. You're seeing the productivity story. I see it personally on my team using AI, how much more we're able to do, how much more software we're able to create without even software engineers on our team. So you're seeing, we do think you're seeing measurable signs of the demand signal being real, but in terms of how it's quantifying to the bottom line, I think you're still early for the economy at large. Certainly, some companies are benefiting, but for the economy at large, still early. Now, the debate in the market every day is, can this CapEx from the hyperscalers like Microsoft, Alphabet, Amazon, Meta, with these $200 billion numbers from Amazon and Microsoft and Alphabet, a little bit less for Meta, can that continue? But then the question is, whose earnings does that capex become? And so this is like the sort of bottlenecks for AI, the chip designers, memory and packaging. Clearly, the big story this year has been the memory names like Micron, Hynix, and Samsung. You got the future of optics with Lumentum, Coherent, Corning, with all their roles in the optics story, the power to get all these chips up. Soon, maybe the chips won't be the bottleneck, but how quickly we can get them powered up will be a key issue. And then you've got the clouds, the neo clouds, Amazon, Oracle, and the stories behind all those companies doing this compute infrastructure. One of the things we talk about, WTAI is our flagship AI fund. It owns this whole package at the bottom. So it's basically our broad AI fund that goes from the chips, the memory names, really trying to say all the spending from the hyperscalers, whose earnings does that become? And that is what our broad WTAI fund is designed to do. Now, when you listen to, where is the advancements coming and signs that it's real? I mean, actually today, and I could say this is not just an AI story, but you got excitement today in biotech with the news from Moderna and Merck having developed a vaccine that could be customized for cancer discoveries, and it was like one of the first examples of customized vaccines for cancer. I've been saying for a little while that I thought that one of the greatest places that AI is going to have an impact is biotech, that there's going to be so much drug discovery happening because when you think about what your DNA is just data. You put the DNA data through the AI machines, and they're going to discover all sorts of discoveries. And the question will be, can the regulations keep up with the amount of new drugs that come to market as quickly as you ideally would like? But you're seeing all the major AI firms making big investments in this exact space, from Anthropic, OpenAI. There's new startups coming that are being funded to go after this space. It's one of the real, you could say, tangible benefits. Even when Dario, the CEO of Anthropic, was talking about, the on social media this week about AI, he talked about, when will AI develop cures for cancer? And I think that's going to be not just the hype, but it's actually going to come. These real discoveries are going to be along the way. It's one of the things that's exciting about AI. And I'd say for the chips and all these other places, I think the next wave is physical AI, and you're seeing all this with humanoids and drones, and robotics, and this is definitely, I think, when Jensen started talking about the growth that he gets from hyperscalers buying their chips. This is really, one of the next big waves of where is that demand for the chips and infrastructure going to come from, is, when will you have the chat GBT moment for humanoids and drones? I think you're seeing in some ways the drone case with the war in Ukraine and from Iran using drones to for their attacks, I think the amount of spending we're going to be doing on this type of technology is really being, you could say from from the war standpoint, very clear that the drones are a key feature of what's happening. But it broadens out from that kind of military application to the consumer application. You just saw this week, Uber announced a big partnership with Zipline. Zipline is one of these drone delivery companies. And I think you're just going to see more of the defense technologies coming to consumer applications. This is going to be one of those next phases of taking the AI story forward. We launched an ETF, WDRN, for physical AI, humanoids, and drones. That's really the going beyond a broad AI fund to this sort of physical AI fund. We think this is the future, the next phase of what's going to drive AI forward, and we think there's a lot of potential behind all that. Now, the hyperscalers are being debated, and I think the question of all this compute they're building out, will there be demand for the compute, all that CapEx coming back to that I started of what's driving all those stocks. We wrote this piece called the SPR of compute that if you have a conflict in Asia, we have the tensions with Russia, Ukraine, and Iran in the Middle East today. There's fears about Asia and in China and Taiwan and what's going to happen with that potential conflict in the future. And if there is a real conflict in Taiwan, the compute that's in the ground that all these companies have been building becomes much more in demand and much more valuable. It's sort of like they have an SPR, the Strategic Petroleum Reserve of compute. And there's this whole debate on what is the depreciation schedule of these chips and the compute that people put into ground. What you're finding is a lot of these chips are still appreciating in value far beyond what people thought, that old chips are still being used, and even the cost of these chips are still going up. So largely, it's a thesis that we think the spend is going to continue and the demand is real, and that they now have this big infrastructure. You're seeing companies like SpaceX sell their compute. There's talks of will Meta sell some of their compute, but they have an installed base that they can sell out because it's so in demand that there's prices going up on all that. Now, Meta is one of these battleground stocks that people, again, are fearful of the spending that they've been doing on their $150 billion of CapEx. We've pointed this company as one that we would say the AI spending is paying off. This was from a few earnings calls ago where they talked about, if you think about Meta, they have a pretty simple business model. It's time on their platform, serving better ads, and they got people to spend more time on Facebook. They saw a 14% ads quality bump, and it's leading to better revenue growth. And so their revenue growth actually keeps going at fairly good levels. And it's just this fear about their spending on CapEx for AI that's causing the stock a bunch of trouble. But it's now at one of its lowest valuations in a very long time. It's one of the stocks we think is being unfairly punished for its spending. And we think the spending is real and actually paying off in their own results. So that's just sort of an interesting example of, again, for people questioning the spend from the hyperscalers, we think it's justified. I'm going to talk about just a few quick market level conversations and how we think about a few other places beyond those thematics. We talked about WTI, WDRN for the drones and physical. This is our S&P 500 P ratio, 21 times earnings. It's when we talk about long-term fair value, we often say 20 is our long-term equilibrium PE on the S&P. So it's not dramatically more expensive. You go back to the 2000 tech bubble, we got to 30 times earnings. And if we think about rates going higher today, the TIPS yields got as high as 4% when we had this 30 PE. So it's not really I would say dramatically overvalued. The tech sector, because of the really, really strong earnings growth this year, I mean, you were over 30 PE on this sort of what we call the expanded tech sector that includes companies like Amazon and Tesla that are in the consumer discretionary sector, Meta and Alphabet, which are in the communication sector. This expanded tech, 24 PE, it's very close to its 30-year median. It's nothing like tech in 2000 when you got to 60 times forward. So a lot of people worry about a tech bubble, and we say it's nothing like tech of 2000, where you did have real extreme valuations. They're kind of, uh, we'd say, deserve valuations at this 24p. You could question, will the earnings growth sustain? Every company's got its own idiosyncratic risk, but it's not this massive bubble that we saw back in 2000. Outside of tech, you're below the 20 times that we say is fair value, so 18 and a half times. It's a little bit above the median, but below the one standard deviation above number. So, real reasonable prices beyond that the tech sector, which was 24 times. And so, we say there's no real overvaluation there. And for that equity premium that I teased to start with comparing bond yields, there's a lot of people who say, with that 20 PE, a 5% earnings yield, um, we have zero equity premium. The Wall Street Journal did a piece. There's zero equity premium because of where bond yields were and where the earnings yield was. And we really just say that's the wrong way to look at it. You've got to compare it to TIPS yields, long-term data. Stocks are real assets, earnings and dividends grow with inflation over time. And so, this chart on the left, yes, the number is below where it's been the last 20 years because bonds were such a bad deal and stocks were very cheap for a lot of the last 20 years. Now we're getting closer to fair value on stocks at 20 PE, and bond yields are normalizing. And so at 230, yes, it's below where it was, half of the levels of where it was the last 20 years. But still, this rule of 72, it'll take you 30 years to double your purchasing power with tips, that 2.4% yield, 30 years exactly. With stocks, it's 14 to 15 years for the S&P if you assume earnings growth is on par with historical at a 5% earnings yield. And that's a real forward-looking return, we think. And so you still double your money twice as fast as in bonds. So yes, bonds are more normal, but we wouldn't be rushing to bonds for the return, maybe for defensive nature of it, but not some attractive return. And the environment for stocks is good when you look at the earnings growth. It's been one of the record seasons for earnings. Outside of a real recession bounce back, you've had very, very strong earnings growth that is supporting this market. Now, on the big stocks, there's a number of these that we would argue have become real value stocks. When you think about the Mag 7, a lot of people in the last 15, 20 years, all you had to do was be in tech. But there's definitely more differentiation today. There's only one of these Mag 7 names that has a multiple that was what caused fear in 2000 of the tech bubble. Tesla's at 164 PE. It's certainly not about its business in the car business. It's really a look for self-driving, for humanoids, the robotics, that physical AI story that we talked about, that people are excited about its long-term future there. But Meta at below 20 times is less than the market multiple. So we would say this is one of the more classic value stocks. Nvidia at 22 times, based on its historical earnings, its estimated earnings growth, we'd say this is a classic value stock. Apple, I'd be more cautious on it. 34 times, it's at a decent premium. It's actually the most expensive outside of Tesla, with one of the slower growth profiles. So it's one that in some of our committees we've downweighted Apple. We've leaned into Meta and Nvidia for some of their value opportunities, and even Microsoft at sort of mid 20s is it we'd say is sort of a more reasonable price than some of these other stocks as well. So it's sort of interesting the bifurcation we're getting in among the Mag 7. We talked about thematics and WTI and drones. Our sort of flagship growth fund is QGRW. It launched at the end of 2022 in the bear market for tech, and it's had a very strong run. If you look at the different index providers, how they classify growth and value, there's been a huge spread between the traditional growth uh, indexes and QGRW. So I'd encourage you to look at this. It goes up against the NASDAQ and then the other traditional S&P and Russell growth indexes. It screens for profitability and growth. And because it does that, it has some of these higher sort of forward-looking and historical growth rates. And it has a lot of the same companies as the NASDAQ in the top holdings, but the companies that they hold that we don't hold tend to be slower growers. They just happen to be listed on the NASDAQ. They're not true growth companies. The companies that are unique to our basket in QGRW are the faster growing stocks. I'd encourage you to check out that, particularly versus traditional growth indexes like the Russell Growth. There's been big deviations in some of that. And then I'm going to close on sort of one um, maybe more value-centric idea. I mentioned we thought NVIDIA and Meta were two of our what we call more value stocks today. Our favorite value strategy at the moment is WTV. It's a US value fund. It focuses on dividends and buybacks in particular. And when you look at, the S&P 500, it's got about a 2% dividend buyback yield. The S&P Value Index has a 3.5% dividend buyback yield. This one focusing on high conviction buybacks is over 6%, which I think is a really attractive number. When I look at our data on long-term returns for stocks, they did 6 to 7% after inflation over very long periods of time. If you get 6% just from buybacks, and dividends today, that's a lot of your long-term real return. You don't need a lot of real growth on top of it. So I think this has been one of our favorite barbells with that quality growth strategy, QGRW I just talked about. WTV and QGRW as a better core is one of the things we talk a lot about. Maybe I'll pause. I know we're running up on time here, so maybe I'll stop the formal presentation here.
Jeremy, thank you very much for that. And since you ended up by talking about WTV, I want to use one of our participants' questions about that one. It produces a definition of value, WTV, that may surprise investors. NVIDIA is currently its largest holding, and Zoom, Salesforce, and Netflix are also among its top positions. What does shareholder yield capture that conventional price to book or low PE definitions of value can miss? And why can a company commonly labeled a growth stock qualify under that framework?
Yeah, it's interesting. I mean, there's a lot of, you have to really drill into people's index methodologies to see how they get to some of their holdings. I mean, the S&P 500 value, I showed Tesla as one of the most expensive stocks in the market, yet it's actually a top 10 holding in the S&P value index because if they have a slow enough growth rate, they're not pure growth by their definition, and then they get some weight in the value benchmarks. We are trying to find the cheapest stocks in the market with also some quality filters as well. And dividends and buybacks are our primary screening tool. But also, it's an active fund, so we have some flexibility in what gets included. But it's, the average PE on our basket, instead of something like 18 for the S&P value, we're at 12 to 13. These are much cheaper stocks, and that average buyback yield and dividend yield combines over 6%, basically 2 to 3 times the level in the S&P 500. So we're definitely buying stocks discounted by the market. We like that the companies are buying back their own stock. They think they're sort of investing with their money, that they think the stock is cheap. And so that's one of our flagship value funds today, been one of the sort of top performers in the value category.
Jeremy, our time is up. Thank you very much for your segment. For additional information about WisdomTree and its funds, please visit the sponsor's website where you can access the relevant fund prospectuses. For questions about today's conference, contact RedChip at 1-800-REDCHIP or at info@redchip.com.
Thank you.